What is up guys, Taiki here, and in this video I want to discuss how I use money markets to manage my portfolio on the Avalanche ecosystem. So if you like the content, please like and subscribe and leave a comment in the comment section below, so let's get started. None of this is financial advice. So a lot of people call me the money markets guy on YouTube because I talk about money markets all the time. In fact, I use money markets like AAVE to manage my portfolio using collateral assets such as Bitcoin and Ether, maybe Avalanche, Phantom, or the Phantom ecosystem, etc., and earn double-digit yield on all my assets. Because if you're not earning double-digit yield, then like what the hell are you doing, right? So this is a screenshot of AAVE on Avalanche. So let me just kind of briefly explain the deposit APYs here. So let's just focus on Tether, right? So if you deposit Tether, you're lending it out, right? It's a borrowing and lending protocol. You earn 2.7% paid in Tether, right? This is stablecoin yield, but you also get paid 3.28% paid in the AVAX token, right? This is part of Avalanche Rush as a way to incentivize liquidity, to incentivize people to bridge over to the Avalanche ecosystem, use it, and see if they like it or not. On the borrow side, you pay 3.92%, right, when you borrow Tether, but you also get paid 1.83% paid in Avalanche, right? So Avalanche price is going up over $100, hallelujah. If you're being paid in AVAX tokens, then it's a really, really happy place, really comfy place to farm, as AAVE is, I believe, one of the safest protocols in all of DeFi, has the highest total value locked in all of DeFi, and in terms of lending, it has it. So I take the liberty to consolidate the lending APYs here, right? So for example, AVAX here, 1.67 plus 12, roughly 14%. So, I just summed those two numbers. And in terms of the net borrow APY, I just said, hey, for example, Tether, you pay 3.92%, but you get paid 1.83%. So your net borrow APY is 2%, meaning that you pay 2% to borrow Tether. And in terms of the Curve APY, this is how much yield you can earn on stablecoins if you deposit onto Curve, right? So you get 6% paid in swap fees and 16% paid in the AVAX token, right? So Curve and AAVE, in my opinion, are the two safest DeFi protocols, or one of the two of the safest DeFi protocols in all of crypto. So I'm just highlighting it for this example. Obviously, if you go out the risk curve, you can earn way more than 22%, but just to simplify things, I'll just stick to these examples. So let's just recap some simple strategies that I highlighted in my previous videos on how to earn double-digit yield on all your assets. So let's say you're bullish on AVAX, right? It's over $100, you think it's going to go to $200, and you want to earn double-digit yield. What you can do is you can deposit AVAX on AAVE, borrow a safe amount of stablecoins, and deposit it into Curve, right? So you're going to lend out your AVAX, get paid 14%, right? In the form of AVAX tokens. You're going to borrow some stablecoins, right? You're going to pay 2% interest, but who cares if you can deposit it back into Curve and in 22%, right? So hypothetically, you can take $10,000 of the AVAX, earning 14%, and $5,000 of stablecoins, you can borrow that, right? You pay 2%, you earn 22%, so you're net earning 20%. So your initial $10,000 in AVAX is yielding $2,400 in annual yield, 24%, not too shabby, right? It definitely beats, staking it on the Avalanche ecosystems to a validator, because when you do that, you're also locking it up, right? So there's less flexibility there, and you don't have. When you borrow stablecoins, you don't have to deposit into Curve. You can use it to farm other farms out there, or maybe you buy more of that AVAX if you're super bullish, etc. But this is one simple strategy you can use using AAVE and Curve, right? Really, really safe, really, really simple, in my opinion. And if you're new to farming, I recommend you start out with this, right? And you just start seeing the yield for yourself. And maybe as you get more comfortable, expand to other higher risk strategies, that you might want to try. To be honest, even for me as a farmer, I'm pretty experienced, but the majority of my strategy is centered around money markets, and this is the way I earn double-digit yield on all my assets. So I don't think I ask questions about liquidation levels, right? Because how do you use the health factor, right? Aren't you scared that if you borrow half your amount, you're gonna get liquidated? So this is a simple screenshot I took a couple weeks ago, but I'm just gonna utilize this example as a way to, I guess, calculate how much your assets would have to drop in order for you to get liquidated, right? This is assuming that you're borrowing stablecoins. So if you click on the details tab here, right, you get to see this figure, which is the liquidation threshold, meaning that when your borrowed amount, the $5,000, gets to 75% that of your collateral, your position is open to get liquidated, right? And no one wants this to happen. So what you can do is you can take the borrowed amount, which is $5,000, divide it by 75%, the liquidation threshold, and get $6,666, meaning that when I'm borrowing this much, if my collateral drops to this value, I could get liquidated, right? Which is roughly a 35% dip in Bitcoin, which could happen, of course, right? But I think it's very unlikely that this happens overnight because, I mean, if Bitcoin dumps 20% tomorrow, I'm not going to just like watch my position about to get liquidated, right? I'm going to pay off some of my loans because, I mean, yeah, I'm borrowing $5,000, but, you know, it's not like I don't own it, right? I'm just like taking $5,000 and like redepositing it into Curve or something. So generally, I mean, it depends on like what assets that you're lending out, you're borrowing, but generally I keep mine above the health factor above 1.7, since it usually means you get liquidated roughly a 40% drop overnight. And another way to calculate how much your asset would have to drop is taking, you know, this value, which is 10.5K, let's say, and dividing it by the health factor, which would, you know, roughly amount to this amount. So two ways to get to the same conclusion, but you know, me usually 1.7. If you're more risk averse, maybe get it over 2, etc., etc. Okay, so the other strategy I'm going to talk about is, you know, I just want to bring it up just because we had roughly a 15% correction in the markets. Today it looks a little better, but you know, it kind of spooked some people out. And the hedging strategy is essentially a way to short using money markets. And typically I don't recommend anyone short assets in crypto, right? Just because, I mean, on a macro scale, like the market trends up over time. However, this could be an interesting strategy for you to deploy because it has some tax implications. And, you know, if you can like short an asset or yield on it, it could be a way to hedge your portfolio. And this is one of the more reasons why money markets are so important, because if you're a hedge fund or like a whale, money markets allow you to short assets, which could be good ways to, you know, lock up more liquidity in a particular ecosystem. So let's say you want to, you know, like hedge, right? Let's say you're super long ETH and you're kind of worried that ETH, you know, might be nearing your top. You know, maybe this is like when ETH is like $10,000, like whatever your target is, and you just want to hedge your position. What you can do is you can deposit Ether, right? Because you're bullish Ether, you own Ether, and you can borrow ETH and sell that borrowed ETH for stable coins, right? Because, I mean, when you short something, you borrow an asset and you sell it in the open market, trying to buy back lower. And then those stable coins that you, I guess, bought with ETH, you can deposit that into Curve and earn 22% yield. So this is a quick demo, right? This is using screenshots. So let's say you have 1 Ether, right? You know, just deposit it into AAVE, earning decent yield, and you're kind of scared. So you're going to borrow like half an Ether, right? And because you're borrowing and lending the same asset, you're not going to get liquidated, right? Because if the price of Ether goes up, yeah, the amount of money that you owe goes up, but your collateral also goes up. And if the price of Ether goes down, then yeah, I mean, you lose money technically, but you're kind of hedged in the sense that if you, like when you short an asset, you can like buy back ETH for lower and you get the profit off of like whatever difference the price difference when you short Ether. So, you know, let's say you deposit Ether, borrow half an Ether, sell it for stablecoins, you deposit into Curve. What ends up happening, right? So you're gonna focus on these two figures here. So you have $4,000 of ETH, right? I'm just gonna assume that, you know, you're earning. I'm just gonna assume that the price of Ether is 4K, just to simplify things. So, you know, you have 4K of Ether, earning 3%. You borrow $2,000 of ETH, paying 2%, sell for stables to earn 22% on Curve, right? So your net exposure to the ETH is $2,000, right? So half an Ether, while you're earning 22% on $2,000 of stable coins. So let's go over multiple scenarios on what could happen if the price of Ether goes up or down. Of course, if the price of Ether goes up to 5K, it goes up by 25%. So what ends up happening is you're lending $5,000 worth of ETH, you're farming with $2,000 of the stable coins, and you owe 2.5K in debt, right? Because you're borrowing 0.5 ETH, you sold it for stable coins, so you owe 2.5K. So yes, you lose out on $500 worth of profits because you're hedged, right? But that's the point of hedging, right? If it keeps going up, then, you know, you're still hedged, right? So you still make money, you make less money, but at least you're hedged to the downside, and you're earning 22% yield on stable coins. But if ETH goes down to $3,000, you're lending $3,000 of ETH, right? Because you're lending 1 ETH. You're farming with $2,000 of stable coins, right? Because you shorted ETH at, you know, like roughly $4,000, and you owe 1.5K in debt, right? Half an Ether. If ETH is at 3K, then, you know, you owe 1.5K in debt. You make $500, right, by hedging your position. You're down $500, right? But if you didn't do this strategy, you would be down $1,000. But, you know, by hedging, you're only down $500. So, I mean, this isn't that exciting of a strategy, but it has some implications when it comes to taxes and I guess like creating liquidity or I guess sourcing liquidity when you want to enter a new form. So let's say in the case of ETH, right? Let's say you bought ETH December of last year, and you're lending it out on AAVE, and you want to take profits, but you really don't want to, right? Because you want to wait until it hits long-term capital gains. Well, if you do this hedging strategy, you're essentially selling some ETH, right? You're hedging your exposure to ETH while also not selling your initial ETH that you had lending on AAVE, if that makes sense. Also, if you want to delay taxable events, right? Like, let's say you want to go risk off, but you don't want to sell your crypto in 2021 because that means you have to pay taxes in 2022 of April. Well, if you short ETH, right, on AAVE, you're not selling your collateral, meaning that you're not really incurring a taxable event, but you're also hedged against it, so you're technically going risk off without actually selling your collateral asset. That might sound confusing, but it kind of makes sense, right? And also, the last point is it can be a source of capital to enter a new farm. So, let's say, I have a money market position, I want to enter a new farm, but, I just like don't have enough money, right? It's like, darn, like this farm looks amazing, but I just like don't have enough money. Well, what you can do is, if you have Ether as collateral, you can borrow ETH, right? So your liquidation risk is essentially zero. You can sell it for stable coins and enter that new farm. Obviously, if ETH goes up and the farm goes to zero, you lose that money. But assuming that, you're like I guess, confident farmer, and this new farm is probably gonna outperform ETH in the next couple of weeks or whatever. It could be a new way to it could be a way to source capital for a new position. Obviously, if you're new, don't do this, but I've done this before where like I see a new farm, I want to enter it, but I don't have capital, so I borrow some ETH, sell it, right? So I'm net short ETH, but I get to enter a new position, and if I 2x my position that way, then I get the profit. And this hedging strategy is kind of like a take profit strategy without taking on a taxable event, which I think is pretty cool. So that being said, I kind of want to go over other money markets on the Avalanche ecosystem. There's two other ones that I think is really, really cool. And hopefully through these videos, you start to understand why money markets like AAVE is so important to build out a new ecosystem, right? Because it also creates more sticky liquidity for DeFi users. If I can deposit ETH and Bitcoin as collateral on AAVE, borrow against it and farm with it, then there really isn't a reason for me to exit that ecosystem, right? Generally, I have either Bitcoin on the Phantom ecosystem, the Avalanche ecosystem, also because it also it always gives me additional flexibility when I want to farm with, right? Yeah. So let's just go over money markets on Avalanche to see what's up. So the first thing I want to go over is BenQi, right? This is the first money market to ever, I guess, launch on Avalanche, right? That was backed by the Avalanche, by AVA back in, I believe it was mid-August. So this has $3.4 billion TVL, and these yields are pretty cool. And though I prefer AAVE over BenQi because it has more Lindy, it's, in my opinion, it's safer. The BenQi team is innovating, and I do want to highlight the one innovation that they're working on, which is liquid staking. Excuse me. So BenQi is going to launch liquid staking for users at Avalanche. So TLDR is that when you stake your Avalanche to validators, right, on the P chain, right, your Avalanche is locked, right? So let's say you're bullish Avalanche, you want to contribute to the decentralization of the Avalanche network, you stake your Avalanche, let's say you lock it up for a year, you earn, let's say 10-ish% on your AVAX, but it's locked up, right? You can't really do anything with it. Well, with liquid staking, BenQi is going to allow you to take your locked up AVAX that's staked, put it as collateral on BenQi and borrow against it, right? So this is, I think this is actually pretty amazing. And in terms of timeline, I heard it's going to be late 2021, maybe January. I mean, who knows, right? I'm sure a bunch of audits have to happen for this to be a thing, because it sounds like there's a lot of layers, right, and building blocks. So it could be dangerous, right, when it first launches. But I feel like this is going to unlock a bunch of liquidity on the Avalanche ecosystem, which is going to be bullish, right? The ecosystem, right? Because if a bunch of people can borrow against their locked AVAX, farm with it, then you can assume that the TVL on the Avalanche is going to go up, which could be bullish for the price, narrative, etc. So yeah, I kind of explained it here, but this is kind of the money Legos that we talk about in DeFi. And I think there's a bunch of people, right, that's not in DeFi, right, because they think it's too risky, but they own AVAX tokens, they locked it up for a year because they're bullish. Well, if they can do this and borrow a safe amount of, let's say, stable coins to farm with, well, I mean, it can bring more people into DeFi, the ecosystem, and the goal of DeFi, I guess, through my videos and just anything in general, right, is to grow the pie, right? Let's share the love of DeFi. Let's share the love of DeFi, farming, etc. And if this can bring in potentially like billions of dollars into, I guess, BenQi, TVL, could be bullish for, the entire ecosystem, the key token, etc. Lastly, Banker Joe. Obviously, Banker Joe, I mean, like everyone loves, like good old Joseph, but recently, Banker Joe allows xJOE as collateral, which I think is really, really cool. So Joe, right, is a farm token, but you can stake it for xJOE to earn part of the protocol fees. Right now, it's yielding roughly 31% paid in the Joe token, right? So it's an interest-bearing position, meaning that you earn part of the protocol fees. So 31% is pretty good. So this is the AP. So this is the dashboard for Banker Joe. It's the rates are pretty good, right? On the left side, you see the APY. So if you deposit AVAX, you get 5.63% paid in AVAX token, but you also get paid 5.3% in Joe and AVAX tokens. And on the lending side, you pay 13% to borrow AVAX, but you also get paid 10%, right? It's part of the liquidity mining incentives. But I want to focus on xJOE here, right? Because a couple of days ago, they enabled it as collateral and you can earn 30% paid in AVAX. So if you click on that, we see that, 30% here. Sure, the collateral factor is only 40%, meaning that you can't really borrow against your xJOE. I mean, you can, but you can't really borrow that much, right? And because it's a more volatile coin, maybe your health factor should be much higher. Maybe you should only borrow like maybe 15% up to your position, but it's still earning yield. But more importantly, like if you can take your Joe, earning 31%, use it as collateral, and like be paid 30% in AVAX tokens, then technically you're being paid 61% for holding Joe, and maybe you can borrow 10%, put it in the curve, and maybe you can up that to like, let's say 62, 63, 64%, right? Which, gives me more reasons to want to own the Joe token. Because as a farmer, we often think about like, why do I want to own this token, right? Like Bitcoin and Ether, sure, they'll underperform AVAX or other altcoins, but it gives me a lot of utility because I can use it as collateral on all these ecosystems, borrow against it, and enter new farms. So things like this is going to be super bullish for the Joe price, just because it gives more reasons to hold Joe, right? Like I would much rather hold Joe after Banker Joe enabled this as collateral than before, and I'm sure a lot of people feel the same way, and it's one of the reasons price is going up. Okay, so in summary, the Avalanche ecosystem is firing on all cylinders. We got 3 money markets, trusted money markets, increasing the TVL of the entire ecosystem. We got BenQi innovating with liquid staking, coming out who knows when. We also got Banker Joe offering pretty decent yields. All got multiple billions of dollars of TVL. So if generally if there's like billions of dollars in an in like a particular app, it means that it's safer than like other protocols, right? So I often mentioned in my other yield farming guides that I think Avalanche is a really good place to start out if you're trying to get into yield farming, just because I mean the yields are pretty insane, right? And sure, this isn't going to be like life-changing money, but the goal of farming isn't to make life-changing gains, right? Of course, sometimes there's going to be really good farms like DeFi Kingdoms, where if you're early on it, then like it can like give you like some multiples. But I think of farming as a way to slowly grow your wealth over time, and it's a way to outperform like centralized finance yields without really taking on too much risk, right? Of course, there's risk in DeFi, but most of my strategies involve safer protocols, and if you can master these things, then you're going to be super ahead of the curve, and it's a good way to earn double-digit yield on AVAX, double-digit yield on ETH, Bitcoin, etc. Thank you guys for watching, and have fun farming out there.